I am going to have at least 10 and probably more than 10 amazingly positive things to think about after the earnings call. And I'm not alone on this. I'm not the only one who's positive after this earnings call. Let's start with number one and probably the most important one. The bad news was baked in. We're probably at or near the bottom for Tesla ever again in the future. This is not investment advice, but this will probably be a fantastic buy point. That is not just my opinion. I'm seeing it all over the news and prep for this morning. Plus, it went down that much last night in the aftermarket. It was still that much, the same amount this morning, and it's still sitting at that amount now. That doesn't mean it couldn't go down another amount. It could. If sales and earnings, however, only increased by 20% this year, which seems to be about the bottom number that's being talked about, then the market, which had priced in about a 35% increase, is going to take the stock down a peg, and we'll show you some evidence of that in a few minutes. That might be about 10% or more, so we could be down another 20. Yeah, it could happen. But you can never pick the bottom. Could the stock go down for a minute? Sure, but it seems unlikely to give some of the other 9. It seems unlikely when you take into consideration some of the other 9 hugely important ideas coming out of the earnings call. And like I said, I think it'll be more than that. But what about the upside? The upside will be provided by future execution, improved overall market risk on attitude, and other announcements coming later this year, and the interest rates dropping. Pretty much the lowest number I've seen is from Troy Testlake in terms of unit sales next year. He is at 2,070,000. He almost always revises up during the year, and he's not a marketing guru, but is good at looking at the capacities, the actual production, the current sales levels, etc. His analysis would not include anything like Model 3 Plus becoming a huge hit, the potential for additional sales from a new Model Y Plus later this year, or he wouldn't include anything like the successful ad campaign or new marketing initiatives. It wouldn't even include higher sales or margins due to interest rates declining. So taking his number, we would still have a 14% increase just in auto revenue, assuming no major changes in pricing or mix. We can expect revenues in energy storage increasing faster than auto. That's what Elon promised, based on known factors. Other revenues will also be increasing. Thus, you could get to about a 20% increase. If I'm right, and the numbers are just a bit better, due to all of these things above, Tesla might sell another 10% or more. And that beat would be the kind of execution that would really increase stock prices substantially above what people are now projecting. Look, this is Randy Kirk. You know what to do. Hit like, hit subscribe, hit notify. And then, buy Cybertruck bottle openers and join Patreon. I will not have time to go through the 10 fantastic things we learned in the earnings. I'm going to go through 5 of them. I will continue during my 11 o'clock show today. I'll go through at least 5 more. We'll also have Brad Ferguson coming on Good News Thursday later today, and that should be super interesting. Last night's program on Good News Wednesday is a classic with Larry Goldberg. You got to check that out, and I'll leave a card later. All right, let's go through a couple more of these really important things that happened last night in the earnings call. Number 2 on the list of positives was a statement that Optimus will be producing revenue in 2025. Elon says he expects Optimus to be shipping in early 2025. In order for this to happen, Optimus will need to be extensively tested in Tesla factories and possibly in supplier factories in 2024, maybe even in third-party situations. It can also do moderately, he says, it can already do moderately specialized tasks. But then went on to say, but to make millions of them, you need a, quote, smart robot that can do generalized tasks. This was the quote. All of this is right in the earnings call. I went back last night and I went over it line by line. Number 3, this is also Optimus. And obviously, that same software and approach, this is a quote again, will enable Optimus to be doing useful things and enable Optimus to learn how to do things simply by looking. In other words, they have made a clear decision not to slowly move good enough robots into the factories in small numbers, but to wait until they have a bot that is capable of generalized tasks and trainable by watching somebody do them so they can build millions. They're not going to go, okay, we'll do 10,000 this year and 100,000 next year. No, they're going to go and they're going to put together this bot that's going to be incredible, and then they're going to build millions. This was clear. If you read the statement, go ahead, go back. There's transcripts everywhere. Look at it line by line like I did. I think you'll come to that conclusion. I'll provide a couple of more of these incredible aspects of the call in a few minutes, but we've got other Tesla news. Adam Jonas at Morgan Stanley leaves his PT, his price target at 345 after the call. He only modestly adjusted his very bearish number for 2024, but maintains his position that Tesla will execute on AI in ways that will justify the stock price target. They do expect the stock to trade down near term. Sawyer Merritt reports this, that Canaccord Genuity has lowered its Tesla price target to 234 from 267, but maintains a buy rating. They put out this good note, according to Sawyer. It's time to be patient. The next generation vehicle, FSD upgrades, margin improvement, and Optimus will likely bring an acceleration in revenue growth, but not this year. 2024 will be a subdued, probably a trough, but still relatively slow. They model an 18% revenue growth. That's only 2% off my number. Growth curves are seldom smooth, and Tesla is no different. From Gene Munster, I expect shares of Tesla to drift lower tomorrow, meaning today. That said, they're making the right decisions for the long term. Gary Black says, I have reduced my full year 24 Tesla adjusted EPS from $3.75 to $3.40, my full year 25 EPS from $5.50 to $5.10, and my full year 2030 adjusted EPS from $22 to $21 to reflect management's guidance of a 20% tax rate. So basically, he's making all his adjustments based on the tax rate. Accordingly, my Tesla 6 to 12-month price target falls to 290 from 300. Wall Street has reduced their full year 24 to 30 estimates based on volume and adjusted earnings per share. All right, here's number 4 on my list of amazing stuff that was in the earnings call. Good news from the earnings call. Okay, over a 9% drop in cost of goods for all models during 2023. Jeff Lutz calls this unprecedented. Yes, now some of this was the unwind from crazy high cost of goods due to the supply chain, all those imbalances during the boom and bust. I think we have every reason to believe, however, based on the call, based on specific statements in the call, the cost of goods will drop another 5% in 2024 on the 3, the Y, etc. If I was a legacy car maker or even one of the startups in the BEV space, and I heard this call and could do the math, I would be shaking in my boots. They are not going to be able to follow with this kind of a 5% decrease, if you will, in their cost of goods sold. This doesn't count what will happen with Optimus working on the line. This doesn't count things like switching over to a 48-volt system in some of the cars, maybe this year, maybe next year, but maybe we'll see some of that happening as well. It's going to be unbelievable. Another 5% decrease. Imagine that they could decrease the price of the cars again 5% this year and maintain the surprisingly high margins that came in last night. Number 5 in my list of 10 or more, we have absolute clarity on the Gen 3 rollout intention being mid-2025. We don't have to speculate anymore. I'm a little surprised it's this late. And they might be under-promising based on some of the dots that we've been connecting, but the markets do like a solid plan. I'm sure you do too. We don't have to we don't have to speculate anymore. We've got the number, and guess what? In terms of the long-term value of the stock, it doesn't matter whether it comes out later this year or in mid-2025. So again, I'll do way more of these good news items. Believe me, the rest of them are just as good as that 5, and it's kind of shocking. So that'll be around 11 o'clock California time. Okay, this from the Washington Post. Now we're switching to the economy in general. I want some more good news this morning. The U.S. economy grew by a bustling 3.1% in 2023, shaking off recession fears and offering an upbeat picture of consumers and businesses ahead of the pivotal election year. Growth slowed slightly in the last 3 months of 2023 to an annual rate of 3.3%, down from the 4.9% craziness in the previous quarter, according to the Bureau of Economic Analysts. The latest figures show the economy has returned to a stable footing following a period of dramatic pandemic-fueled swings that marked 2020 and early 2022. So you had 3.3% in the fourth quarter, and this was way higher than the 2% that was expected. The article goes on to say the doom and gloom that prevailed last year has been swept aside. This is according to Philip Carlson Schlizak. Anyway, I can't pronounce that. Global chief economist at Boston Consulting Group. The pessimism has been punted out quarter after quarter. That spending by everyday Americans accounted for most of the economy's growth in the fourth quarter. Increased government spending at the state, local, and federal level, as well as higher exports and more private and residential investments, also lifted the latest GDP reading. It sums up all that. So there was also decent increases in business spending, which is always what you want to see if you're going to have a continued bull. All right, Wall Street Journal says this. This is the negative side of what's going on. Credit card spending is up, and customers aren't paying off their charges as quickly as they used to. Credit card loans or unpaid balances on accounts jumped 14% at JP Morgan and 9% at Bank of America. Credit card loans were also up at Citigroup and Wells Fargo. So again, people are running out of the money and they're starting to spend on their credit cards. So this is an issue to watch in terms of the negative side going forward. However, the stock market right now is definitely predicting, at this point, the stock market is predicting that we will not have a recession in the third quarter. We'll see what happens as the month continues. Market Watch had this to say. Initial jobless claims rose 25,000 to 214,000 in the week ended January 20th. This is the highest level in a month. But this is where they've expected the level for a while. This is still a very good number. The economists polled by the Wall Street Journal had expected 200,000 because they're just guessing. Last week's claims fell a revised 14,000 to 189,000. That compared with the initial estimate was 187,000. So we have a very slight adjustment there. So basically what we've got is continued strength in the job market. We have got continued strength in the overall business environment, although it may not feel like it out there, and the consumer certainly isn't feeling it, although there's some consumer confidence building. And as we head into the PCE tomorrow, truflation is still sitting at 1.86, and this is now over a week at this level. Then we had durable goods coming in flat in December, according to the Commerce Department. Economists had forecast a 1.5% rise in orders for durable goods, but they didn't get it. We got a flat reading. But core capital goods, which excludes transportation and defense, rose 0.3% last month after a 1% rise in November. What I always wonder is when they do the core on this one and they take out transportation, why they don't acknowledge that that means the transportation was actually a negative number. So transportation fell last month. Interesting there. Then from the PMI website, from the Purchasing Manager Index website, very, very important. Listen to this carefully. Businesses in the U.S. signaled a stronger upturn in activity at the start of the year as output growth quickened to the sharpest rate in 7 months. This expansion was driven by service providers as manufacturing continued to see a drop in production amid intensifying supply issues. Nonetheless, a broad-based improvement in demand conditions was reported as firms reported stronger new order growth for both goods and services, helping push business confidence for the year ahead to a 20-month high. On the price front, overall input costs rose at a slightly softer pace at the start of the year. That's good news. While firms raise their prices at the slowest rate since 2020. So we've got Cinderella happening here. Companies in the U.S. recorded another rise in employment during during January, albeit slightly lower than seen in December. This increase in staffing numbers was only marginal overall, and the second softest since late August. Panelists highlighted, this is a big thing, greater workforce numbers were due to increased business requirements and the hiring of skilled workers for long-held vacancies. But that hiring was often constrained by labor shortages still. So people are starting to now need specific categories, and they're starting to hire in those categories. There's more. Believe me, this goes on and on. I'm sorry, this is a long one this morning. The Kobesi letter says something is happening in the rental market. In Q3 2023, the vacancy rate spiked to 6.6%, its highest in over 2 years. Meanwhile, asking rents in the U.S. fell for a third straight month in December to $1,964 a month on average. Asking rents are down 2.1% year over year, marking their largest drop since 2020. However, the buyer's market is still showing record low affordability. Well, okay, so this has been talked about all year. Rents were at zero. Now we're showing negative numbers. The Fed has to act. We'll see what happens on the PCE tomorrow. I'm thinking if the PCE is zero tomorrow, the Fed could even act next week to lower interest rates. I mean, it's crazy. They're gonna miss this opportunity to it's going to go below 2%, and they're just going to be upset again. So Business Insider says this, according to Rosenberg Research, 80% of U.S. stocks are owned by Americans at or close to the age of retirement, over 55. And that's a big problem if the economy tips into recession. Here's why. It's according to Rosenberg. Retirees don't have the luxury to buy and hold through a market downturn, according to David Rosenberg. If a downturn does materialize, demographically induced selling is a force that could exacerbate the spiral powerfully, with the effects ricocheting into consumer spending. I am 100% in agreement with this. Demographic shift in stock ownership will be and is important. However, I am not aligned on his issue with the old folks not being able to hold in during a downturn. They might choose to sell, but I don't think it'll be because they have problems with their finances. The folks that are owning those stocks, their finances are fine. And I think these are long-term holders for inheritance purposes. That's just me. Now, the older they are, the more likely that is. Of course, the 55 to 65-year-old group might still be trying to generate more and more financial stability for their retirement. All right, having said all that, what is the market doing now? Let's take a look. We have got Tesla. We'll start with that. This is the not so great news. Boy, it's just staying right at that number, 189. It's down 18.74% in a market that is, the Dow is up 168, the NASDAQ is up 51, the S&P is up 20, and the what do you call it? Magnificent Seven are mixed, well, almost all up and up nicely, with Amazon being the only other one that is down, and that's only 65 cents. We have the Cathie Woods also mixed, but right around break even. The entire group is pretty much very close to break even. All right, let's turn this into percentages. We have got the Dow up 0.45%, NASDAQ up 0.29%, S&P up 0.4%. That's pretty close to alignment for once. That's pretty interesting. Tesla is down 9% at this point on compared to the close last night. Then we've got okay, and that is all of that. Let's go ahead and see what's happening to bonds. Last time I checked, they were definitely the yields were headed down. The yields are still down 4 basis points. We're sitting at 4.138. So right now, the bonds seem to be suggesting that they're believing the 0.2% for tomorrow. If it comes in at 0.1%, I'm talking about the inflation rate. If the inflation rate comes in at 0.1% or 0.0% tomorrow, 0.0%, you like that? Or 0%, or maybe even -1. It could happen. It happened I think it happened last month. It was -1, which is why I am inclined to think it will not be negative, but it could be 0, it could be 0.1. If that happens, I think the bond rally tomorrow will be huge. That is not investment advice. However, do your own homework. Let's look at the rest of the bonds. We've got pretty much across the board. The short-termers are not down. The yields are not down as much as the long-term, but all of the long-term, including the 1 year, are up. The yields are down about the same thing, around 4 basis points. Okay, now let's take a look. Last time I checked, oil was up because we do have problems in the oil patch. We did have a drawdown in U.S. inventories. That drawdown in inventories, now we have oil at $76.57 for basically the 24th of January. To have it go up that little tiny amount based on cold weather is pretty impressive. That means the inventories are still pretty dang strong and production is still very strong. Production has not been affected very much. All right. And so Brent is still split by under $5 now. Natural gas up 2%. It has a long way to go to recover. We have gold up $6, sitting at 2022, right in the middle of the range it's been recently. Copper is down 0.1%. Nothing significant there. We've got the dollar edging higher because why? Because of the strong GDP numbers. And we also have, that is all of the info. Oh yeah, I'm sorry. Bitcoin. I'm sorry for all you Bitcoin holders. It is finally up. It's up 300 this morning, but that's still under 40,000 at 39,992. All right, let's go back and check Tesla to see if it's still sitting there at exactly 189. It is just, man, that is the number this morning. It is not moving around much at all. All right, so what are you going to do? You're going to hit like. You're going to hit subscribe. You're going to hit notify. Then here is the card. You are going to go back and listen to that episode last night with Larry Goldberg if you haven't already listened to it. The comments were extremely positive. The numbers were huge. And then you need to listen to the entire thing if you really want all the good stuff that Larry had to say last night. A reminder again, later this morning, I'm going to give you at least 5. Let's say probably another 10 and maybe even more. Amazing. I mean, really solid, positive things that came out of the earnings report last night. If anybody would figure out the value of Tesla stock right now based on where it's going to be 5 years from now or 3 years from now, instead of just worrying about next quarter or this year, the stock would not be down this morning. I'm guaranteeing that. The future is absolutely amazing. So you want to hit notify to be reminded of that. And of course, that I'm going to be with Bradford Ferguson tonight. We'll be talking, of course, about all of this, plus what happened today in the market. You don't want to miss that. And then join Patreon. Please join Patreon. And then buy a Cybertruck bottle opener. Last chance. One more time on Tesla. Actually up a tad here. We're at 190 now. Looking forward to talking to you later. It has been great talking to you this morning.